Are you unsure whether to invest in mutual funds or fixed deposits? Let us guide you in making the right choice. In today's video, we'll compare these two popular investment options. Mutual funds are market-linked investments offering growth potential, while FDs provide guaranteed low-risk returns. But which one suits your financial goals? We'll break down the key differences to help you make an informed decision. With recent changes in tax rules for debt mutual funds from April 2023 and a rise in FD interest rates over the past year, the question is more relevant than ever. Should you invest in debt mutual funds or stick to FDs? In this video, we'll discuss debt mutual funds, equity mutual funds, and FDs. A detailed comparison of their returns, risk, taxation, and suitability for different goals. By the end, you'll have a clear understanding of where it makes more sense to invest based on your needs and preferences. Fixed deposits are one of the most traditional investment options. With an FD, you lock your funds for a fixed period and in return, you earn a fixed interest rate. It's a secure, low-risk way to invest your money. FDs are offered by banks and financial institutions with guaranteed returns and zero market risk. The tenure and interest rate are predetermined, so you know exactly what to expect. Some of the main benefits of FDs include guaranteed returns, safety, and low risk. They're ideal for risk-averse investors or those looking for stable returns. However, FDs have limited growth potential. The returns might not keep up with inflation, and the interest earned is taxable, which reduces your net returns. FDs are best for short-term goals, low risk tolerance, or if you just want a secure, no risk investment. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or a mix of both. They offer a more dynamic investment approach and can be tailored to different risk levels. Mutual funds come in several types: equity funds, debt funds, and hybrid funds. Equity funds invest in stocks, debt funds focus on bonds, and hybrid funds mix both to balance risk and returns. Mutual funds are ideal for investors who have a moderate to high risk tolerance and are looking for inflation-beating returns over the long term. Mutual funds offer potential for higher returns compared to FDs, especially equity funds. There's also flexibility. You can invest via SIPs or lump sum investments, and some funds offer tax benefits like ELSS funds. However, mutual funds come with market risk and returns are not guaranteed. Doing proper research or consulting a financial expert before investing is important. Fixed deposits provide fixed, predictable returns with no market risk. But these returns are often lower than what you can get from mutual funds. Mutual funds, on the other hand, offer market-linked returns, which means higher growth potential but also exposure to volatility. FDs may not always beat inflation, which means your real returns could be lower. Mutual funds, especially equity funds, have the potential for inflation-beating returns over the long term. In terms of returns, FDs usually yield around 7%. And once taxes are considered, especially for those in the 30% tax bracket, your post-tax returns would be closer to 5%. Debt-oriented mutual funds also tend to offer returns around 7%, but some higher risk funds can provide returns of 10 to 11%. However, these are more volatile. On the other hand, equity-oriented mutual funds tend to offer returns around 11% before taxes. After taxes, the return drops slightly, but it is still significantly higher than FDs or debt mutual funds. Post-tax, you can still expect around 10% from equity mutual funds, which is double the returns from debt mutual funds and FDs. When we talk about risk, FDs are the safest option with very little chance of loss due to bank failure. Debt-oriented mutual funds carry low to moderate risk as they may invest in corporate bonds or other higher risk bonds that could offer better returns. Equity-oriented mutual funds fall under the moderate to high risk category because of their exposure to the stock market. While they offer higher potential returns, they are more volatile and have a higher risk of losses. FDs allow premature withdrawal, but it comes with penalties. Mutual funds generally offer higher liquidity, especially in liquid funds or open-ended schemes, making it easier to access your money when needed. FDs follow a one-size-fits-all approach with no active management. In contrast, StackWealth offers customized mutual fund portfolios called stacks, designed for your specific financial goals, and wealth managers actively monitor and adjust your portfolio. If you have short-term goals, FDs might be a better choice. However, for long-term goals, mutual funds tend to offer better growth potential. Think about how comfortable you are with market fluctuations. If you're risk-averse, FDs are safer. But if you're comfortable with some risk for the potential of higher returns, mutual funds could be the right option. If you're looking for higher returns, mutual funds, particularly equity funds, are your best bet. But if you prioritize safety and stability, FDs may still be the way to go. For short-term investments, FDs are a better choice, especially if you need returns within 1 or 2 years, such as saving for a car, a house, or children's education. Debt-oriented mutual funds also make sense for short-term investments as they provide a safer alternative to the stock market while offering returns higher than FDs. Equity-oriented mutual funds are better suited for long-term investments, typically for 5 years or more. These funds are ideal for goals like retirement, where the risk and volatility of the market can be balanced over a longer time horizon. Let's break down how taxation works on these 3 products, starting with FDs. The tax is applied according to your income tax slab rate. If you're in the 30% tax bracket, then the tax on the profit earned from the FD will be 30%. This remains unchanged for 2023. Moving to debt-oriented mutual funds, the tax is now aligned with the FD taxation structure. Previously, investors benefited from a 20% tax on long-term capital gains with indexation. But after April 2023, these funds are taxed at the same rate as FDs. So, if you sell after 3 years and make a profit, the full profit will be taxed at your slab rate, meaning a 30% tax on your gains, which is a significant change. Lastly, for equity-oriented mutual funds, if your capital gains are below 1 lakh in a year, you pay no tax. However, if your gains exceed rupees 1 lakh, short-term capital gains tax of 15% applies if the investment is held for less than a year. And long-term gains are taxed at 10% if held for more than a year. In conclusion, the key question is whether people will shift towards FDs now that debt mutual funds are taxed similarly. FDs may be the preferred choice for short-term investors, but for long-term goals, equity mutual funds still offer better returns. Let me know in the comments where you plan to invest after these changes. If you enjoyed this video, please like and share it with friends and family who might benefit from it. Don't forget to subscribe and press the bell icon to get notified about more finance videos. See you in the next one. Keep learning, keep earning, and stay happy.
StackWealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high-performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign-up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert-curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching and goodbye.